and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, we're back with Tim Sustak, our Chief Treasury Officer for Vizo Financial, and Scott Wood, our Chief Investment Officer for Vizo Financial. Scott, the FOMC meeting is next week. What economic indicators will the Fed be focusing on prior to next week's meeting?
Yes, they meet next Wednesday and middle of summer. Everybody's on vacations and taking it easy, but the Fed is ever vigilant, ever looking at that data. They keep telling us we're going to be data dependent, and they seem to be very data dependent. And you know what they've been looking at a lot here recently, as we've talked about, has been different inflation measures, CPI, PPI, and the PCE deflator. PCE deflator is kind of their preferred gauge of inflation. And guess what? We have a reading coming out this Friday. So the Fed will be eagle eyes with that, right? They're going to be paying a lot of attention to the PCE number that comes out on Friday. So we had CPI and PPI, Consumer Price Index, and the Producer Price Index both came out earlier this month. The CPI fell overall to 3%, and then the core was 3.3. The PPI actually rose. Producer prices rose a little bit, 2.6% overall and 3% core, excluding food and fuel prices. And then the last PCE reading we had was a reading of 2.6% overall and core. And as we all know, the target of the Fed is 2%. So overall, we've talked about this in the past. We had that really big decrease in inflation from that 9 point some odd percent. We've come way down from there. And things have gotten a little bit kind of sticky at this 3% range, 3 to 4% range. So, but the most recent trends have been heading back lower again. So the PCE deflator will be highly watched by the Fed this Friday to see if that is going to follow the CPI number and come down. Now, is that going to be enough to move the Fed at next week's meeting? Probably no chance of that. So a lot of the Fed members have been out and said that they want to see some consistent data for a couple of readings. So we could look at this as like, okay, this month's of PCE, CPI, PPI is that first. Well, consider that first reading, and then, in August we'll get another reading of these inflation measures, and that might set them up for something in September. But so they're looking at that. They continue to look at the unemployment rate and how employment is going, because they have that dual mandate, right? Prices is part of it, but so is employment. So they have those two things to keep an eye on. So they're going to continue to look at employment data. We've talked about this in the past meetings too. We're starting to see an uptick in the unemployment rate. So in January, the unemployment rate was 3.7%. The most recent reading, which was, I believe, June data, was 4.1%. So we're up 0.4% in since the beginning of the year. And when this whole cycle started, the Fed, they told us that they anticipated with the raising rates that we would get an an unemployment increase also of this 4.2 to 4.5% range, somewhere in there. And we're right on the door of that too. So they're keeping an eye on that. Obviously, they want to make sure that the economy they're not unnecessarily hamstringing the economy, causing job losses and things like that aren't necessary. So, so they'll continue to really keep an eye on the inflation reading this Friday, and then future unemployment reports or employment situation reports.
Okay. Thank you. Tim, so I'm kind of thinking I know your answer, but I'm going to go ahead and ask it anyway. The Federal Open Market Committee has kept the benchmark interest rate unchanged for 7 consecutive meetings. Will this meeting be the 8th, or are we looking at a change?
Yes, it will be the 8th. That's all I have to say about that. I certainly agree with Scott. I think it will absolutely be the 8th. Very little, if no chance that they'll do anything at this meeting. And a number of things point to that, right? I mean, number one, the Fed speakers that we've all heard, the vast majority will tell you, hey, we're not ready to lower rates yet. To Scott's point, we heard, the latest economic data that Scott just talked about. Inflation, the last few inflation readings, they're kind of going the right way, which is a good thing. But that's not enough of a trend for the Fed to make a move yet. Certainly, to Scott's point, we'll see what happens with PCE this Friday. If we can keep this trend going, I also agree with Scott. I think if things continue along the manner that we're seeing now, moving into September, I think there is certainly a chance there that we could see a move. But there's a lot of roadway to be had between now and then. So we'll see what happens there. But certainly nothing happening in July. And to Scott's point, we'll see what the data says between now and then to see if we could get. The common theory is you think you want at least. The Fed, I should say, wants at least a quarter's worth of data pointing the way they want it to, in order to get enough confidence to start, the easing cycle. So, like I say, we'll see if we get there. I think the thing we have to keep in mind too is, and this is something that came, but it's something the Fed's been saying for a long time. Sometimes the markets come out with something that they think is novel, but in actuality, if you're listening to Chair Powell's press conferences, he said this a long time ago, and that is, look, they're not going to wait till we hit 2% to cut rates, right? You're going to cut in anticipation of getting there when all the signs are pointing that we're reliably moving towards 2%. If we wait till we get to 2%, it's going to be too late. You're probably going to retreat the other way. So they will cut ahead of that. They just want to make sure that they are on the type of trend where they feel confident that we're not going to hit another rocky patch, that we're going to keep moving reliably downward.
All right. Two of you are on the same page again. One of these days, you guys will have a disagreement, and we're waiting for it. So, Scott, have you changed your prediction? Or are you still thinking we might have one potential rate cut this year? And if so, when do you think that might occur? Or you think September's higher probability?
Yeah, so it gets tricky now, right? So we're at that point in the cycle where the Fed is ready to move. The markets have been waiting for the Fed to move for a year, really. They thought the Fed was going to cut a while ago. We're at that point now where it can happen at any time. As Tim and I have said, it's not going to happen next week. It's just not. There's not enough data. They want to see a little bit more of a trend of downward shift there in inflation. But barring any surprises, could the Fed cut in September? Certainly they could. That would meet the criteria of about a quarter's worth of data heading in the right direction. We're not going to be at 2%, as Tim said, but we're heading in that direction. We had New York Fed President John Williams had some comments here in the last week, as well as Fed Governor Christopher Waller. They were talking about they would like to see, again, a couple of more months of data going in the right direction before they were comfortable with the rate cut. So that would rule out this next week, but it would certainly put September in play. Okay. So if the data continues to cooperate with the Fed, if we continue to see, a downward movement in inflation, then they could certainly move in September. And if you look at Fed fund futures today, Fed fund futures are basically slightly under 100% odds of a September rate cut. Now, if you were there a few days ago, they were over 100%. So, and that's mid-September. So the markets have been back and forth, yes or no for September. They could certainly do it if the data agrees. And the markets now are building in 2 to 3 rate cuts this year again. I'm going to go on record again saying that they're being overly aggressive again, as they tend to have been doing for the last couple of years. Mm-hmm. They're really looking for the Fed to be really aggressive on cutting rates. Could the Fed get aggressive? They could. If unemployment continues to tick up and inflation continues to tick down, then the Fed can be more aggressive. So yes, we're going to see, I would imagine we're going to see 1 rate cut this year, potentially 2. I'm not going out for 3. So if they cut in September, then they could certainly make 1 more rate cut this year and give them a little room. So there's an incentive for them to go early to do the September rate cut. Okay. So they have 2 more meetings where they could cut 1 or 2 more times. I'm curious what Tim thinks about this, but I don't think the Fed's going to do any more than 2 this year. And really, I think 1, sticking with that November rate cut. It's just the way it's feeling right now. It really feels like September's in play and that we could see a move in September.
Okay. Well, Tim, what do you think? Or do you agree with Scott? Are you thinking one and potentially two?
Yeah, I think that's reasonable. And I do agree with that. I mean, I just think that, unless something drastically changes, right? And with the way the world is now, who the heck knows, right? But I mean, if we keep moving along the way we are now, I completely agree with that. I think, you definitely get one, maybe two, but they're not in a hurry. They've and like Scott said, the market wants to rush things. They're paid to anticipate, and they've been pushing, but it certainly didn't work at the beginning of the year. It's not going to work now. The Fed's going to do it when they're ready. And I think, patience is the order of the day for them. So they're going to make sure that they're set the way they want to be before they start easing. And I don't think they're going to be pushed to do it before that. So I agree with Scott.
Okay. All right. Tim, I always have to ask you about liquidity. Can you tell me what you're seeing on the liquidity front?
Yeah, really more of the same, which isn't a bad thing. Especially what we've, given what we've been through the past couple of years, it's still pretty safe and sane out there. I mean, just looking at the whole, certainly, looking at the corporates numbers, deposits are still strong, well over where we had been certainly in the past year or two. And, although we're seeing some bleed off here going into the summer, which we always see, deposits are certainly at a higher level than they've been. And the same thing with lending. Lending has ticked up just a bit here, June and July, but nothing anywhere near to what we were at last year at this time. So I think overall, most credit unions are feeling in a much better situation liquidity-wise. This year, certainly than last. Things seem to be hanging in there in the summer months so far. I mean, really, August, September will be the test in earnest to see where we are, I think. But for right now, things are good. That being said, there are still some out there that struggle more than others, particularly, I think, those credit unions that place some bigger bets in the securities markets out longer. Some of those folks are still struggling to kind of right the ship because waiting to a point where they can sell those securities, which is going to be a while, or to get some maturities coming due, and it's taking a little longer for them. So that's a little more of a problem. And also those credit unions, certain pockets where either in the area that they're at, there's a little more competition for deposits, or, just because of the nature of their membership, deposits are a little harder to come by. They're struggling a little bit too. But other than that, right now, I think overall, generally, things are certainly better than last year, and people are feeling pretty good liquidity wise.
All right, great. So let's talk auto and mortgage. So Scott, could you share a bit about what you're seeing in the auto and mortgage environment and how this impacts credit unions?
Sure. I guess a couple things. We actually talked about some of these in our internal meetings, internal ALCOs. Our credit group has some good data. There's been a lot of good data by some of the credit rating agencies about what's going on, especially in the auto market. So I think we've been talking about it here for the last few of these that Tim and I have done, that there has been a deterioration in auto loans. So there's been some delinquency increases, pretty sharp, actually. When you look across the board nationwide at credit, the two areas that have been highly impacted have been autos and credit cards. Both of those have seen some pretty heavy delinquencies and defaults over the last few months. With that said, for the most part, for most of that time, they've been below where we were pre-pandemic. I think we started to see a little bit of an increase above where we were pre-pandemic levels. But what we've seen here recently is it's really a tale of two different credit scores: the prime borrowers versus the those under prime, whether they're subprime or just somewhere below prime. The prime borrowers are the delinquencies are starting to slow. One of the big concerns that I had coming into this whole thing was during the pandemic when people were borrowing at really inflated car values, right? Whether it was new or used, but we had a really shortage of new cars, so people were getting new used cars where they could, but the values were very inflated. If you remember, there was a really big spike in used car prices, new car also. So people kind of, in a sense, overpaid unless that became a new normal. Well, it's not really the new normal, but it did last for a little while. We have seen both new and used auto prices have been coming down. So what that's going to do is some of these cars that maybe are delinquent and go into default, it could create issues for credit unions. There could be some losses involved there. And we have heard that there are some losses there. The autos that have really taken a big hit have been electric vehicles. They have lost a lot of value over the last couple of years. And partly it's been because there's been a lot of new entrants into this space. Before Tesla dominated, but then over the last 2 or 3 years, there was a big push by the big US automakers to be involved in this space. So we had all these excess cars. Demand has started to wane. People have kind of backed off on their desire. Some of the early adopters bought their electric vehicles. So anyway, Tesla started cutting prices. Others have started cutting prices. It's funny. I was watching a video yesterday, if you can believe this. Nissan has a Leaf electric vehicle. It's a small electric vehicle. So I was watching a video where this gentleman went into a Nissan dealership, and for $2,000 down, he was able to lease a brand new Leaf for less than $10 a month, which I thought was crazy. But for $10, $9, I think it was $9.55 a month was his lease payment.
Wow.
Because of the residual value was going to be pretty strong, and there was the tax credits and everything else to apply. So yeah, $10 lease vehicle, 2,000 down, which is pretty reasonable.
Yeah.
He was able to lease this new vehicle. So if you're looking for a new electric vehicle, this may be the time to jump on it, especially maybe on the leasing side. But anyway, there is a little bit of weakness on the auto side. On the mortgage side, certainly there's been a slowdown this year on home sales. A lot of that has been driven by mortgage rates. So twofold, right? We have these higher mortgage rates for buyers, and we have potential sellers who have really low, a lot of them have really low mortgage rates, sub 3%. So they're loath to give up those rates. You don't want to, if you've got a sub 3% mortgage right around 3%, you don't want to give that up easily. So you're not putting your house on the market unless you absolutely have to, in most cases. So the supply has been limited. The number of people buying homes has been limited because of the higher interest rates and the higher home values. Delinquencies on the home side have been relatively tame, although there has been an uptick, which surprised me a little bit, right? When you look at the Fed data, there's been a little bit of an uptick. And partly, I think it's been driven by people that bought adjustable rate mortgages. They got into adjustable rate mortgages early on in this cycle, and then the Fed continued to raise so aggressively. So some of those people are feeling some stress. But on both fronts, autos and mortgages, credit unions are probably seeing a slowdown. There's different reasons why, but there's overabundance of autos right now. If you go to auto dealerships, lots are full. And it's a lot of that is obviously they ramped up production, but another part of that is consumers have kind of slowed down their buying a little bit here. So so maybe a tough next few months for credit unions to get loans out there in autos and mortgages. Okay. Maybe that you focus on the HELOCs, unsecured lines, things like that.
Okay. All right.
Oh,
sorry. Go ahead, Tim.
I'm sorry. Can I add on something to that? It was just interesting. I was reading a report today on CNBC. Cox came out with their auto report for July 2024, and just to add support to Scott's talk about autos, they reported that car repossessions are up 23% compared to last year, which is also 14% higher than what it was 2019 pre-pandemic levels. So, all those things Scott talked about are coming home to roost. And I don't know what those stats are just for credit union land, but you can be sure that credit unions are seeing that as well. So
yeah, definitely.
Yeah, I imagine it's pretty similar, right? Because credit unions were pretty aggressive.
Yeah.
During the pandemic, early on in the pandemic with auto loans and everything. And I know Tim and I have had some conversations with different credit union folks, and yeah, they've certainly seen an uptick in delinquencies, repos, voluntary turning in car keys and things like that. So it's definitely weakness around the fringes, and as Tim and I and others have talked, there's that concern that it becomes more widespread. And I think that's kind of the Fed's concern too, right? That
Yeah.
they don't want it to get super widespread.
Hmm. Wow. Well, Tim, I'm going to ask you another question. Based on recent events this weekend, I have to ask my next question. How will the current political climate affect these and other economic factors?
Well, Jamie, before I tell you that, let me tell you what the Powerball numbers will be for this next drawing, and then we'll go forward. In all seriousness, I guess I would say this. I mean, the obvious answer is who knows, right? I mean, we're still at a point where obviously, the big announcement over the weekend with President Biden not going to seek re-election, Vice President Harris, kind of the obvious next up, if you will. But we don't know that for sure, right? I mean, that still remains to be seen. So we don't even know for sure who the Democratic candidate will be. But I think this goes back to, what I think Scott and I had talked about before, and that is, there's a lot of uncertainty in the marketplace right now, right? You've got wars going on, a lot of geopolitical things, and there was certainly some uncertainty before President Biden's announcement, and now there may even be more, right? So I think that is the known that comes out of this, is it just adds another level of uncertainty for the markets to deal with, which they typically don't like. And when that happens, there tends to be more volatility. So, who knows what's going to happen, right? Except that I believe anyway, I don't know if Scott feels the same, but this will just add some more bumps to this rocky road that we're traveling along here to see what's going to happen. As the rate picture folds out, we may be getting a little bit more certainty there, maybe. But just as we get that, now this gets thrown into the mix. So I think we just see a little more volatility as we move through the end of this year is what I'd say for it right now.
Okay. All right. Scott, what else would you like to share with our credit union audience today regarding the current environment?
Well, first, Tim and I are like Siamese twins or something. We on all the, seems like on everything, but we will diverge at some point. Fred and I certainly had our differences of, economic outlook at different points of time. But yeah, I think, what Tim said is key. There's just a lot of uncertainty in the marketplace right now. We're in that inflection point for rates being, cutting rates with inflation coming down. We've got this really uncertain political landscape. We've got a presidential election less than 4 months away. If you think about that, and we still, as he said, we don't know who the Democratic Party's who the nominee is going to be there. We did know the nominee until Sunday. So there's all that uncertainty, and as Tim said, the markets, they don't like uncertainty; they like certainty. So this is just going to certainly has the ability to create some havoc. Not like we saw during the financial crisis, hopefully nothing like that, but certainly some volatility, so you may see rates move up and down a little bit. Same with equities, obviously. What I would say to our credit unions out there that have liquidity, if you have liquidity and you've been sitting on the sidelines for different reasons, I would say this is a good time to deploy some of that cash into the markets. If we are getting to a slowdown, your liquidity is probably going to build anyway. But I'm not suggesting that you overinvest by any means, but certainly consider putting some money into the marketplace at the levels where we're at today. I know it's tough when the Fed's at 5.25. We're paying, 5.45 in the flex account, and then you go into the marketplace for 4 or 5 years. You're talking, under 5%, 4.60, 4.80 range. That's tough. You're like, why would I give up 50 or 60 or 70 basis points of money today? And the reason you would do it is because you think the Fed's going to be cutting rates, and you're going to lock in some yields that will kind of help you weather the storm when we get below those levels. So, and again, be careful on how you invest your funds, and we're happy to help you with that, certainly, and help you with some levels, rates and suggestions. But take a look at deploying some of that money if you do have excess, whether it's agencies, bullets, things that will kind of hold their yield for a period of time. It could be treasuries, it could be mortgage-backed securities. Just be careful with mortgage-backs that, if we get lower rates, there may be some pay downs coming for those type of things. So they may pay down quicker than you think. So just be aware of that. But That's what I would do. And again, just continue to listen to the Fed. We'll have that meeting next week. Listen to Chairman Powell when he comes out afterwards and starts answering questions. If you don't listen to him, at least, read somebody a write-up, a news article about it, and hear what he has to say. We're not going to get an updated dots plot or economic projections at that meeting, but certainly there'll be data, nuggets in what Chairman Powell has to say, and potentially in the Fed's official statement too. If they think they could start cutting rates in September, there'll probably be a change in the official release, and that'll kind of give us a little bit of a clue that it could be coming in September. So that's what I would pay attention to.
All right. Okay. Tim, any final thoughts for our listeners?
Yeah, I think I would just say, don't lose sight of liquidity. Even though things are looking up, things are certainly better than last year. And, we don't see anything on the horizon that would, say it's going to get really scary again. Obviously, you never know, but I can tell the NCUA certainly hasn't forgotten about the last couple of years. And without fail, credit unions that I'm talking to that are, have either gone through their exam or are going through an exam, the NCUA is still very interested to see what you're doing with liquidity, how many external sources you have, if you're certainly approaching that $250 million mark, do you have a federal backstop in the CLF or the Fed? So, that concern hasn't died yet, even though we're looking better. So make sure you still keep an eye to that. Certainly reach out to us if you need any help with Fed or CLF, anything like that. And also if you think you get into a point where you might need some help liquidity wise, reach out to Scott's group, my group. We're always happy to help you with, all the liquidity tools we have. We'll be happy to walk through all of them with you and see what fits best for your shop and your balance sheet.
All right. Well, thank you both so much. Really appreciate you taking the time to join me today and provide this insight for our credit union members. All right. This episode of Financial Minds Meet the Experts, it's brought to you by Vizo Financial's Financial Conference. Vizo Financial would like to formally invite you to attend their biggest financial event of the year, their 2024 Financial Conference on September 11th through the 13th at the historic Omni Grove Park Inn, which is an exquisite hotel nestled in the mountains of Asheville, North Carolina. During this event, they will host expert speakers who will present on topics like interest rate, loan performance strategies, economic and political updates, as well as various investment opportunities and more. And did I forget to mention luxurious spa and golf activities? Because, of course, Vizo Financial only wants the finest for their guests. Register today at Vizo Financial's website at www.vfccu.org. As always, thanks for listening and make it a great day.